started. So look, we're going to focus on capital gains today, and probably a good portion of the next class. I assigned initially all of the first and second sections of Chapter 7 investments for reading and for homework, but we're a bit behind. So I don't know that we're going to get to actually part 1, which is really dealing with how to calculate the interest and report. So with qualified dividends were one section, and then it was dealing with the bonds and how to calculate if you bought it, at original issue or if you bought it on a secondary market. I'll see how much time we spend today, and I'll have a better feel at the end of this class. My gut says we're not going to get to it. So we'll start with capital gains today, okay? And we'll focus on that, and I'll figure out whether or not we'll get back to the other one. Okay, guys, so Chapter 7 started off talking about different sorts of investment assets. And like I said, the first part of the book, the chapter started dealing with, how to calculate taxable income on different types of these assets. They're all different types of property income, okay? So they're all unearned forms of income. And with the exception of qualified dividends, okay, most of them, the ones in Section 7.1, are really going to be ordinary income. These are types of property, guys, that you're buying, and pretty much you're buying them because you want some sort of return, okay? So you're going to collect some interest, you're going to collect a dividend, okay? They're making you wealthier as the year goes on. You're actually receiving money. Now, capital gains are a little bit different, okay? You might still purchase an investment asset, but when it comes to a capital gain property, really, guys, what you're purchasing is you believe this property has good appreciation value. You're not so much purchasing it because it's going to pay you a dividend next week or, some interest next month. You're really purchasing this because you think you got a good price on something, or you think that this asset is really going to go up in value. And if you have some money and you have some time and you can afford these two things, you're going to hold this for the long term. And the benefit of these types of investments, as opposed to those that pay you on a regular basis, is that, first of all, the income is going to grow tax deferred, okay? That portfolio can grow. If you buy a piece of property and the value of the land goes up every year, right, there's no realization event. Okay, you haven't entered into a transaction, you don't have different property rights. So, that can grow and grow and grow, but you're not paying taxes on it. But when you do finally go to sell it, okay, capital gains property entitles you to special tax treatment, preferential rates, which is a good thing. Again, most of the other properties are going to get taxed at ordinary rates unless they're qualified dividends. If you have a capital gains property, you're going to get beneficial rates. So this is a good thing for you if you hold it for a certain period of time. And that's what we're going to look at today. Guys, hopefully everyone printed and brought with them the capital gains handout. I asked you guys to print it and bring it, so hopefully you do have it. Because this is what we're going to use as the basis of class, okay? We're going to walk through it. Look, guys, capital gains and dealing with capital gains all starts with Code Section 1221 of the code, okay? 1221 defines what a capital asset is, and it defines it in the negative, okay? 1221 says everything an individual owns, whether in his individual capacity or as a trade or business, everything he owns is a capital asset, okay? Everything. It's a really big term. So everything is a capital asset, okay, guys? Your school books are capital assets, your clothing are capital assets, your cars are capital assets, your houses are capital assets, everything is a capital asset, okay? But then it goes on to say, except for these 8 things, okay? And for purposes of our course, we're really only worried about 3 of the 8. The first one is accounts receivable. Accounts receivable is never a capital asset, okay? Inventory. Inventory is never a capital asset. And the third one is depreciable personal property or real property used in a trade or business, okay? Those 3 things are never going to be capital assets. Can anyone tell me what those 3 things have in common? Sorry?
Personal items.
Inventory, accounts receivable, depreciable personal property, or real property used in a trade or business. Guys, these are all business assets, right? Sorry, they're the opposite. These are all business assets, okay? These are everything held by a business, almost everything held by a business. So as far as individuals go, okay, everything is going to be a capital asset. Everything, okay? But you do have to stop and look, okay? You can't just say, oh, it's a capital asset because it's not an inventory, it's not accounts receivable, it's not depreciable personal property. You also have to stop and look and say, well, how is the person holding it, okay? I could be holding something in my personal capacity, or I could be holding something in my capacity as a sole proprietor. So how am I holding this asset? It's not just enough to look at the asset and try and make the determination. You have to look and see, well, how do you own it? How are you using it, okay? And here on the handout, I use the example of a car, okay? For most of us guys, you know, our cars we drive every day, those are gonna be capital assets because I'm using them personally, okay? And again, if I'm using it personally, there is no exception to the capital asset rule. But let's just say I own a small dealership. It's my sole proprietorship, okay? And I have a bunch of cars, okay? That's gonna be inventory, okay? So you have to stop and look and say, you know, how are they holding it? Who's holding it? What are they using it for? Then make the determination. So don't try and blindly make a determination without really looking past to see who's holding it and how they're holding it, okay? Look guys, now capital assets, I don't want you just to hear the word capital asset and think, oh, capital asset, capital gain, or capital loss, because that's not always going to be the case, okay? We were just talking about dividends, we were talking about interest. So you guys could hold bonds, okay? You could hold a bank account that's earning you some interest. You might have some rental property you're collecting rents on, okay guys? If you're holding and using these assets, they're going to be paying you ordinary income. Even though they are a capital asset, as long as you're hanging on to them and using them for their return value, okay, they're producing ordinary income. Qualified dividends are going to be the exception to that rule. In that case, okay, if they qualify, if the taxpayer holds them for 61 out of 121 day period, okay, he may qualify for qualified dividends, which get also a special rate, okay? But now compare it to a capital gain or loss, okay? So we were just talking about a bond. Typically, if a bond is paying you interest, guys, it's going to be ordinary income because you're keeping that bond and you're using it for its income-producing value. But when you go to sell the bond, now you're getting rid of it, okay? So on the disposition is when you may qualify for this capital gains treatment or loss, okay? So one, you're keeping it, it's probably producing ordinary income, but when you're going to get rid of it now, you're disposing of it, is when you may be entitled to this capital gain or capital loss treatment. So know the distinction between the two. Don't hear capital asset and assume, oh, I'm entitled to a capital gain, because that's not necessarily the case. Okay. So we're going to go ahead and we're going to get rid of our capital assets because we do want to focus on these capital gains. So when we're disposing of our capital assets, guys, we have to first calculate the amount of the loss or the amount of gain that we're entitled to, okay? And Code Section 1001, I've mentioned this before, is the code section that tells us what is the amount of gain we're entitled to, okay? And code section is in the handout there, guys, but look, Code Section 1001 simply says, look, it's the amount you realize, what you're receiving, okay, what you're taking in, minus what you're giving up, the adjusted basis, is your realized gain or loss. So breaking this down a little further, the amount realized, okay, this is what value am I getting in order to give up this asset, okay? Is it cash that I'm selling it for? Maybe I'm getting services performed for me, right? Don't just think of cash. Anything, the fair market value of any property you receive, the fair market value of any services you receive, could be debt relief you get, right? Guys, those are all tentative income to you, okay? So those could all go towards your sale price, fair market value, minus any selling expenses, okay? Did I have to pay someone to help me dispose of this property? Was there any cost involved in the sale of this property? You have to take that off of your amount realized. And be careful with the terms here, okay? This is your amount realized. This is what you're receiving when you're giving up the property. Your adjusted basis, okay, has a couple of different components. It starts off, guys, with your acquisition basis. I told you guys before, when you acquire an asset in tax, you also get some sort of tax basis with it. And it depends on how you acquire the asset. And I've listed a bunch of different ways here. So if you purchase something, right, it's your cost. You take a cost basis on the asset. And it's not, guys, just what you paid for it. I didn't just pay $10,000 maybe for my car, okay? There's taxes, okay? Was there any shipping costs involved? Was there any installation costs involved? Did I have to pay an attorney to help me, purchase this asset, okay? Any costs involved in bringing this asset to its purpose are gonna go into that cost basis, okay? So don't just look, for one number, because there may be several numbers that make up that cost. In the case of gifts, guys, we talked about this last class, right? You take the donor's basis, the carryover basis, if it's a gift. If it's an inheritance, you're gonna pull in the fair market value at the date of death, okay? That becomes your basis. And then I included on here prizes, awards, and treasure trove, right? That'll be the fair market value when you acquire the asset. That will become your basis. So that's the starting point, okay? You might have made improvements to the asset in the period of time you held it. You have to add those on to your basis, okay? And you might have some cost recovery, and cost recovery really, for the most part, guys, is gonna be depreciation. But if it's an intangible, it could be your amortization, could also be depletion, okay? So your adjusted basis may move over the course of the life that you're holding this asset. But that's gonna be, guys, this is our return of capital principle, right? If you make an investment in an asset, you are entitled to get that investment back tax-free before you have to recognize your gain, okay? So start with, what did I receive minus the cost, my investment, get that back tax-free, okay? And this is your realized gain or loss, okay? Now again, watch the terms. This is your realized gain or loss, right, guys? We've talked about realized. You entered into a transaction with another taxpayer, and as a result, your ownership rates are different, okay? But just because you have realization doesn't necessarily mean you have recognition. So be on the lookout. Don't just say, oh, amount realized minus adjusted basis, therefore I'm going to take this as my capital gain, okay? Be on the lookout. Are there any exclusions that apply? Okay, we've talked about a few. And I've listed a few here. In particular, in the case of the personal residence, right? You might be entitled, your house is a capital asset. So you might realize a certain amount of gain, but you're entitled to possibly a $500,000 exclusion. So you need to pull that off. There may be deferrals that are going to say you don't have to recognize that loss this year, okay? And we're going to talk about losses in a few minutes, okay? Losses aren't always allowed. So the difference between your realized and your recognized gain is going to be, are there any exclusions, deferrals, or losses that apply, okay? You have to know the terms here, guys. You have to understand amount realized is what you're taking in. Your realized gain or loss, again, guys, this isn't necessarily what you're going to report on your tax return. Be looking for exclusions, be looking for deferrals, be looking for losses. Then your recognized gain or loss is ultimately what you're going to report for a transaction, okay? I included an example down the bottom here. So we have Tina and Tim. They sell their house. They bought the house 18 years ago for $185,000. So that was their cost basis, $185,000. They sell it this year for $865,000, presumably in cash, okay? That's gonna be their amount realized. That's what they're receiving in exchange for the house. They had to pay their real estate agent 5% commission on the sale of the home. And additionally, they're eligible for the 121 gain on personal residence exclusion, okay? So our sentence here would start with the $865,000 amount realized, their sales price, minus the 5% commission that they had to pay to their broker, okay? So I don't know the exact number there, but it's presumably 820, whatever you say it is. If I asked you on an exam, what's the amount realized, don't just assume I'm going to ask you for the gain, guys, okay? I could ask you, what's the amount realized? Okay, your amount realized would be 821,000 something, 750, okay? Minus their adjusted basis, again, that's what did you pay generally for the asset, the cost basis, but if it was a gift, you would use the donor's basis. If it was inheritance, right, you would use the fair market value at the date of death. That's their realized gain, okay? But again, realized does not automatically equal recognition. So there's an exclusion that applies here. You have to take that into account. So take that $500,000 exclusion out. And in this case, now they have a capital gain of $136,750 that they are in fact going to recognize for this particular transaction, okay? That's how we get here. We're starting to pull together all the pieces of things we've been learning, okay? Okay. I've listed a few of the losses here, but we're gonna get to all of those as we keep moving along. Okay, guys. Now, it's not just enough to be able to calculate how much, okay? When you have this capital asset, you also have to be able to look at it and understand some more information about it, because that's going to help you even further, okay? The first thing you have to understand is what was the holding period, okay? If you held it for exactly 1 year or less, it will be considered short term. It will be considered a short-term gain. And that's important because short-term gains, if you end up with a net short-term gain, it's still treated as ordinary income. You're going to record it as a capital gain on the face of your 1040, but it'll be taxed with the rest of your ordinary income dollars. Okay? Long-term is anything you're going to hold for more than 1 year. And these long-term gains are the ones we're seeking. Ideally, if you're holding this type of property, you want to hold it for more than a year, because this is when you're going to get the beneficial 0, 15, or 20% rate, as opposed to the much higher up to 39% rates. Okay? There's also some other types of assets out there, okay, that kind of complicate matters even more. There's what are called collectibles, okay? Collectibles get beneficial treatment, but they're not as good as our standard long-term capital gains, okay? The rule says there that if you're taxing them in the 10 or 15% categories, they will get the 10 or 15% rate. But once they fall outside of that, they're going to get taxed at 28%. Look, guys, 28% is still better than 33, 35, 39%, but it's not as good as our regular long-term gains. Okay, collectibles, guys, you know, it's going to be things like artwork. It's going to be things like you have a collection of, you know, old cars.
Jewelry.
I'm sorry? Jewelry. You can have a collection of jewelry. You can have, stamp collection. You know, anything of a value of that nature is going to be considered a collectible. Again, it is a tax-preferred item. It does get a beneficial rate, but it's not as good as our standard long-term capital gains.
I have a question. Say they had $136 as gain, right? How would the tax that they should pay?
We're going to get to all that.
So the collectibles are always at the 28%?
Not always 28%. We'll walk through an example. The rule says that the maximum rate they get taxed at is 28%, the maximum, okay? We'll walk through an example, Jarrett, that will kind of help you figure that out. We may not get to it today, but we will get there. Okay. Then there's also something called Uncaptured Section 1250 Gains, guys. I'm not going to get into the details of what this is today, because we're going to study this when we get to businesses in a few weeks. But just know that if you hold real estate and you sell it at a profit, this has to do with the recapture rules, okay? You were allowed to take deductions on this real estate that you held in a business and offset it against ordinary income, and that drove down the basis of your property. So if you sell this property at a gain, what they're saying is that really the reason for the appreciation, you're selling it at a gain now, is because of these paper deductions that you took. And those paper deductions were offset against ordinary income. So to the extent you have a gain on this property that you're now selling later on, and as a result of these paper deductions, they're going to make you take it at a 25% rate, as opposed to giving you the better, 0, 15, or 20%. We're going to get into the rules behind why. Okay, guys, on an exam right now, I will just tell you it's a 1250 gain, okay? And I just want you guys to know that it'll get taxed either at 10, 15, or 25% maximum, okay? We'll walk through an example of this as well. Okay? So you don't want to just calculate how much. You also need to understand more about these assets. What's the holding period? And are they special types of properties, meaning collectibles, or meaning this 1250 type of property? Because then we have different sorts of rates in the mix, and we have to tax each of them differently. Okay. Losses. Let's get back to losses. Okay, guys. So I started with gross income, saying, in tax we use this concept of realize and recognize when we talk about income. Okay. When we talk about losses in tax, we say they have to be realized, they have to be recognized, and they have to be allowed. Okay. The IRS does not like losses. Okay, so when they see losses, they kind of clamp down on the rules. Okay, they don't freely give losses, which is why we said they have to be realized, recognized, and allowed. Okay. Okay. There is a code section, because we're focusing on individuals right now. There is a code section, 165, that says in the case of individuals, losses are only allowed in one of three situations, okay? Losses are allowed when they're related to the taxpayer's trade or business, okay? They are allowed for transactions that the taxpayer entered into specifically with a profit motive in mind, okay? Or in certain casualty and theft situations, something like my house burned down, there was a bad storm, okay? They'll allow losses for individuals in certain of those situations, okay? Yes, if you entered into a transaction for profit. You enter into this transaction, you have a profit motive in mind. That's your main purpose here. Okay, guys? So if you look at this list, guys, it eliminates a lot, okay? And what it does eliminate for us individual taxpayers is anything that we use in our personal life. Now, we said as individuals, everything we own is a capital asset. Okay, but we just, here, nowhere does it say if you sell anything, you get a loss, right? You can't deduct personal use assets, losses, okay? If you sell your car at a loss, you don't get to deduct it, okay? You could bet if you sold that car at a gain, they're gonna tax it, okay? But if you have something that you're using predominantly in your personal capacity, you cannot deduct the loss from it. So this is a big exception. They will deduct, tax your gains. They're not going to allow you the losses on the other side. Okay. If you do have a loss allowed as an individual, and typically, guys, this is going to come in when you have investments, like a stock portfolio, okay? Because when you buy stocks, okay, when you buy bonds, you're buying them with the purpose of making money, right? Whereas if you buy your house, people could try to make the argument like, oh, I bought my house, I knew this area was up and coming, and I know it was going to make a lot of money, so really I bought my house with the intention of making a profit. But the IRS is going to say, yeah, but you're living in the house. So your primary purpose for that house is really you needed a place to live, okay? Same thing with your car that you're driving every day. You really need this car to get around, to live your life, okay? You didn't really buy the car with the intention of making money off of it. But when you buy investment properties, okay, you're generally buying them because you want to make some money. So in those cases, you are going to be allowed to take a loss, okay? But again, it's not a freely given loss in this case, okay? The rules here say, as an individual, if these losses are in fact allowed, okay, they're going to restrict them. They're saying you could take these losses up to the extent you have any capital gains, so you can wipe out any capital gains, and if after that you still have some losses sitting there, you could take $3,000 more, okay? And you can use that $3,000 and you can report it as a loss on the face of your 1040, and it'll offset other categories of income like your salary, okay? And if you still have a loss after you use that $3,000, the rest of it you could take and you can carry forward to next year, okay? You can keep carrying it forward until you use it. It'll offset future year's capital gains, okay? So even when you are allowed to have a loss in a limited situation, guys, it's going to be restricted. So like I said, you see a loss, be wary. More than likely, you're not going to be allowed to take it if it was personal use. If you are, because it's something you went into for a profit, guys, it's going to be restricted, okay? You're never going to be allowed to just really freely use a loss. Okay, now we get to the fun part. Okay. Netting, okay? There is a very, very specific netting process in the code, okay? And you have to follow it, guys, and you have to follow it in the order you're being told to follow it, because if you try to do it another way, it's just going to send your whole problem wrong from start to finish, okay? You have to work in the order that you're told to work. Don't try and, do it one way or another way. Do it in the order that you're told to do it, because otherwise your answers won't come out right. So first we're going to focus on problems, guys, where we don't have any of these collectibles or any of this 1250 property. Okay, we're going to focus just where we have some long-term gains that are eligible for the 0, 15, or 20% rule, because that'll be a little more simple. And then we'll bring in the 28% and the 25% after we get through these initial ones. Okay? So look, the first part of the netting process, guys, said you might have a series of these capital gains transactions. You might have sold a bunch of stuff this year. Okay? You might have sold 2 things, you might have sold 10 things. So you're gonna go through this initial exercise for all of them, okay? You're gonna mark them held long-term, you're gonna mark them held short-term. And then once you do that, what you're gonna do is you're gonna take all of your short terms and net them together. And then you're gonna take all of your long terms and net them together, okay? Shorts, longs. You have to do this first. Shorts and longs. Don't skip it. Don't try and just net everything all together, okay? And what's gonna happen, if you look here, you're gonna end up with one of four results, okay? The first one here, we've got, you end up with a net short-term capital gain and you end up with a net long-term capital gain, okay? No further netting needs to be done here, okay? I just, if you have the handout in front of you guys, just presume we have $15,000 of short-term capital gains and we have $5,000 of long-term capital gains. So what would happen in this case, you would take and you would report $20,000 of capital gains on your 1040. It would be line 13. You would report $20,000, okay? Then what would happen is you would work your way through your tax return, take off any deduction, and you would come to taxable income, okay? When you come to that taxable income line, you're gonna pull out the preferred gains. The preferred gains are only the long-term ones that get the special rates, right? We said short-term gains are taxed at ordinary rates. So you're gonna leave them with the ordinary dollars. So if I have $50,000 of taxable income, I'm gonna pull out the $5,000 of long-term gains. I'm gonna tax my $45,000 of ordinary income using my regular tables. Then I'm gonna go and tax my $5,000 of long-term capital gains. We'll do a couple of examples, okay? If you end up with two losses, okay, short-term and long-term, you'll use, well, in this case, there's nothing else to offset. You'll use $3,000. You'll take a $3,000 loss on your 1040, okay? And then the rest of it, you're going to carry forward. And the rules say you have to use your short-term losses first and then carry forward everything else. So again, if I had $15,000 of short-term losses here and $5,000 of long-term losses, I would use $3,000 of the shorts on the current year return, okay? I would carry forward $12,000 of shorts, and I would carry forward $5,000 of long in that case, okay? Now, in the last two steps, we end up with one gain and one loss, okay? It doesn't matter if it's, short or long term, okay? In this case, they're saying net it further, okay? If you end up with a mix, take it and net it further, okay? And come up with either an overall loss or an overall gain, okay? If you end up with an overall short-term gain, it's just going to be taxed at ordinary rates. You're going to report the gain itself on the capital gains line, okay? But it's just going to get taxed with the rest of your ordinary income dollars because short-term losses don't get special rates, okay? If you end up with a long-term gain overall, again, you're going to report it on the capital gains line. It's line 13, okay? But when you get to that taxable income line, you're going to pull this amount out and you're going to tax it separately. We'll do a bunch of examples. And then if you guys end up, again, if you end up with an overall loss, whether it's short-term or long-term, okay, you're going to use up to $3,000 of it, and anything that's left over, you're going to carry forward, okay? So, we'll look at the example. We have taxpayer, Sarah, and she sells a bunch of these assets during the year, okay? So she's going to go through her exercise of calculating out the amount of her losses for each of these assets, okay? So she sold some stock, she sold her wedding dress at a loss. She sold her engagement ring and she made some money on it. Now look guys, I made the point of scratching out her wedding dress, okay? You have to be going through the list of transactions and looking out for things that aren't capital assets, okay? Was there inventory? Was there accounts receivable on here? If it is, get it off because it doesn't qualify for special tax treatment, right? And then you want to be looking for losses on personal use assets, right? Because you're not allowed to take those. So get it out of your list. Get it off your list of transactions. You only want the things that are going to qualify for the special treatment in here. And that loss isn't going to qualify. So get it off. Scratch it out before you move forward. Okay? So after we scratch it off, guys, the first step is you net your shorts, you net your longs. Okay? We have one short-term loss of $8,000, and we have two long-term gains of $9,000, right? If you have a mix, one negative, one positive, net them further, okay? Here, we're going to end up with a net long-term capital gain of $1,000. I'm going to report that $1,000 as a capital gain on my 1040, I think it's line 13, yes, it says it there, okay? And when I get to taxable income, I'm gonna back that $1,000 out, and I'm gonna tax it separately. I'm not gonna include it as part of my overall ordinary income that I'm gonna use the regular tables for, okay? Another example. We have Mark, okay? He sells the following assets this year, okay? Inventory, he sold inventory, okay guys? Again, I'm being obvious here. Quick, get it off the list. Inventory does not count as a capital asset. It's not gonna get beneficial treatment. Scratch it off, okay? Then he has 2 remaining assets. They're both lost, one short-term, one long-term. You don't wanna net it further down. You want them to keep their short and long-term character in this case, okay? The rule says there's no gains to offset here. So he's allowed to use $3,000 of this loss to offset, let's say, his salaries or other income that he may have on his 1040. So he's going to report a $3,000 loss on his 1040, and then he's going to carry forward the rest. He has to use the $3,000 first from the short-term amount and then from the long-term amount. So he's going to end up carrying forward, guys, $1,000 of short-term losses, and he's going to carry forward $6,000 of long-term losses, okay? Okay. I am not going to talk through this next part. I think what we'll do is work through the example. This is the actual taxing. So if we jump down to example 4, look, we have Maria, okay? She's single. I'm telling you she's got taxable income of $48,000. Guys, be careful of the problem, okay? The problem, and I think one of the homework problems did do this, it could start you with gross income, okay? And in that case, they're gonna expect you to work through that tax formula. They're gonna expect you to pull out the deductions, itemized or standard and exemptions to figure out the taxable income. Here, we're just jumping right to the taxable income number, but be wary of what income we're giving you, okay? So we know she's got $48,000 in taxable income, and I'm telling you it includes $25,000 of long-term capital gains, okay? This is the point where I will say to you, okay, you've got taxable income of $45,000, okay? Say 45 or 48, 48, sorry. Okay, and I'm telling you that in here are $25,000 of long-term capital gains. These are preferred gains, okay? Everything else that's not preferred stays and gets taxed at ordinary rates. So the rest is $23,000, okay? And that's gonna be treated at ordinary income rates. So you would just go to the back of your book and you use your normal rate tables, okay? You guys know how to do that by now, so I'm not gonna walk through that step. So if you tax, you always have to tax first the ordinary income amount, okay? This is step number 1. Tax the $23,000, okay? And that's gonna give you a tax using the regular tables of 2988.75, okay? So of the $48,000, we tax the first 23. We still have to tax this $25,000, okay? And here's where it gets confusing, guys, so hang in here. Okay? The rules say, or this is what I will tell you, because I don't think this is the way the book explains it. When you're taxing the ordinary income dollars, right, guys, we're using the 7-bracketed system. Okay? So our taxpayer, we tax the first $23,000, which brought us into this 15% bracket. Okay? So we've used up all the dollars available in the 10% bracket, and we used some of the dollars in the 15% bracket. Okay? The idea when we're taxing now these the capital gains is to pick up where we left off with the ordinary income. So we've used $23,000, okay? Now, when you're taxing the capital gains, take the 7-bracket system, convert it into a 3-tier system, okay? The first 2 brackets become tier 1, and they get taxed at 0%. The next 4 brackets get taxed at 15%. This is tier 2. Your last bracket, think of as tier 3, and this gets taxed at 20%. Okay? So any dollars taxed within these new tiers, you follow the new rates. Okay? So take your charts, the back of your book, whatever, put a big red line after the 2nd bracket, after the 6th bracket, and turn them into a tiering system. Okay? So in this case, we taxed $23,000. For the single taxpayer, tier 1 ends at $37,450, right? So take your $37,450 minus the $23,000 we've already taxed. Okay? That leaves us with $14,450, sorry. Okay? So there's $14,450 of space still available in tier 1 for me to tax. But I have to tax $25,000. So anything past this amount has moved into tier 2. Shelley, you're shaking your head. You're not the only one. Look, right, again, the idea is you want to pick up where you left off. You know we taxed up to $23,000. So we're somewhere in the middle of this bracket, right? Now we flipped over to a 3-tier system when we're doing long-term gains. So tier 1 ends right here. That's the last dollar available for us to tax. So that's why I'm saying take the end of the tier you know you're in, okay? Take off the dollars we know we've taxed. This leaves $14,450 still available in that first tier for taxing.
So that gets taxed at 0.
That will get taxed at 0, okay? So this is going to be taxed at 0, which is $0, okay? But we had to tax $25,000 of capital gains. So far, we've only taxed $14,450. So take our $25,000 minus our $14,450. I believe that gives us $10,550. Yes. Okay, so we still need to tax this amount more. But we've now been moved up into tier 2, right? Because we've completely filled up this and this. Okay, so now we've moved into tier 2. So once you cross over this red line, you're in tier 2, and now these dollars are going to get taxed at 15%, guys. How many people are with me? How many people have I completely lost? Good? Bad? You want me to explain it again?
How did you do it? You're talking to me?
It's both of you guys. Go ahead, what's the problem? Tell me.
So you just minus the 40 from
The 40? No, the 1050, I'm saying, look, I'll start from the beginning. Look, I told you at the beginning the problem.
I don't know, we did the 40 minus the 37,450. Is that, are we able to do that?
No, you don't want to do that, okay? Because this number you have to break into what's preferred, what gets a preferred rate, and what doesn't. Right? I told you in the problem that $25,000 is going to get a preferred rate. So pull that out first. Anything that's not going to get a preferred rate is going to get an ordinary rate. You're going to use your regular tables. So by default, anything that's not preferred becomes ordinary. Then you tax that ordinary amount first using our ordinary 7-bracketed system, okay? And which is where I came up with this amount for the $23,000. Okay? So now we tax the $23,000 of ordinary dollars. We still have to go back and tax the $25,000. Okay? Now when we did the ordinary dollars, we used all of the 10% bracket and we used some of the 15% bracket. And the idea is that with the capital gains, you want to pick up exactly where you left off with the ordinary. So we used up to $23,000 ordinary, and I know I'm somewhere in this 15% range. I don't know exactly where, but I know I'm in there, because 23 falls in this range. So to figure it out now, we move to this 3-tier system. Figure out where the end of your range is for the tier. The end of our tier here is $37,450. Okay? Take out the $23,000 we've taxed, because we've covered this already. And there's $14,450 left in that first tier. Tier 1 gets a special rate of 0%. That's why we're going to tax those at 0, okay? But we have to tax $25,000 of capital gains. So far, we've only taxed $14,450, okay, in tier 1. The rest of these dollars are going to fall into tier 2 because there's no more room up in here. We've taxed $23,000 plus $14,450. That equals $37,450. We've used all this money up, okay? So now we're forced into the second tier. So take the $25,000 we need to tax minus that portion of the capital gains we did. This is how many capital gains still have to be taxed in tier 2. Because they're in tier 2, they get a 15% rate. Okay. which is 1582.50. Okay? So the total tax on all $48,000 is going to be this from the ordinary income, this from tier 1, and this from tier 2. Okay? In total, that works out to $4,571.25. Guys, if you don't get it, stop me because this is really important.
Why do you subtract the 25,000 to the 9, 14, 15?
Because I know in total I have to tax $25,000 of long-term capital gain. So far, I've taxed $14,450 of it. Okay? So I need to know how much more do I have to tax.
Just the difference.
Just the difference. So all this is, yeah, I'm just trying to figure out how many more capital gains dollars do I have to tax. And because these are in tier 2, now they're getting a different rate. We're going to work through another problem.
Why is that in tier 2? The second line.
Okay, because we started by taxing ordinary income dollars first. Okay, so this is the first thing we did. And we've used up, when we did that, we've used up pretty much all of this 10% bracket. Okay, and we've used up some of this 15% bracket. That's tax ordinary dollars first. Okay, now I have to tax my long-term capital gains. There's $25,000 of them. You start where the ordinary dollars left off. So I've left off, let's just say, somewhere about here, okay? And to figure out exactly how many dollars are left, look at the end of your tier, okay? This $37,450 is the end of the tier. Minus the $23,000 I've taxed. Means there's $14,450 still available within that tier for me to use.
Oh, okay.
You got it?
Yes.
So I'm gonna take that $14,450 and apply it towards this $25,000. It gets a 0% rate because that's what tier 1 is. But after I've done this, I still have more dollars in this $25,000 to tax. So my $25,000 that I need to tax minus the $14,450 that I did in tier 1 equals $10,550. And this is now in tier 2 because, right, the first $23,000 plus the $14,450 brings me right up to here, the end of the tier. So now there's no more dollars left in there. I'm forced now into tier 2 if I want to tax all of this income. Okay? We'll do another problem, so hopefully by the end of the second one, we'll make a little more sense. Guys, just think of it. You have to fill up all the dollars as you're going, okay? You can't, where one leaves off, the next one is going to pick up. And the idea is you fill in each bracket as you go, each tier as you go. Okay? Okay. Let's look at, I think it's problem number 44 in the book. This was a homework problem, and it did not go over well in homework, so it'll be a good one to go over. Okay? They give us two married taxpayers, Matt and Meg, okay? And they tell us their salaries, they each make some money. And they tell us that they take the standard deduction, okay? And then they tell us that they engage in a couple of capital transactions. So we have Matt, and he makes $64,000. And we have Meg, she makes $21,000, okay? They're married, filing joint, and they take the standard deduction.
So what example is that?
Is number 44? Oh, no, it's a homework problem in the book. Okay. Part A, they tell us that they have a couple of different transactions. Okay? They have a short-term capital gain, they have a short-term capital loss, long-term capital gain, and a long-term capital loss. Okay, guys, what's the first thing you do? Before you even go there. Don't even go that far yet. Net the shorts, net the longs. You got a list of transactions. Don't go any further. Net your shorts, net your longs. Drill that into your heads, guys. Net your shorts, net your longs. Don't skip this step. Okay? So we're going to end up with a short gain of $7,000, and we're going to end up with a long-term gain of $9,000. Okay? Now we're going to go to our tax formula, because in this problem, guys, they're giving us gross income dollars, okay? It's not like this problem where we started off with taxable income. Now we're starting at the very top of the tax formula with gross income. So we have to work our way through the formula to figure out what our taxable income is, to figure out then what we're gonna tax, okay? So coming to the side, we've got two people, we got salaries of $85,000. Okay? We have capital gains. We would report one capital gains number in this case on line 13. Okay? We report capital gains of $16,000. So we'd have $101,000 of gross income in total. Okay? They've got no core AGI deductions. That's our next level of deductions. So our AGI is the same as our gross income. Okay? Then we keep working through our formula. The next thing we look for is they take the greater of the itemized or your standard deduction. They tell us here that you use standard. Okay? So we're going to use standard here, which is $12,600 because they're married, filing joint. Guys, if I told you in a problem that one of them was over 65, right, they're entitled to an additional standard deduction if they're both over 65, or I should say 65 or older. They're both entitled to an additional standard deduction. Be looking for ages, okay? And they're entitled to 2 personal exemptions, $4,000 each, right? So we're going to take out that $8,000. And that is going to leave us with $80,400 of taxable income. Okay? Now we have to go back, okay, with our capital gains, guys. If you're working this on a test, okay, put a star or something next to it because don't forget, right? Some of these gains are tax preferred. So when you get to this number, don't make the mistake of running to our tax tables and just taxing it all at ordinary rates. This is the point in time where you have to stop and say, you know, is there anything preferred in here that I need to tax separately? We do in this case, okay? We need to separate out only the long-term capital gains, right? We don't want to pull out the short-term because they're taxed the same as ordinary dollars. So leave them in with the rest of the income. Just pull out your $9,000, okay? So $9,000 is preferred. Mark it however you want. And then the remaining $71,400 is ordinary income, okay? Everyone with me so far? Good? Everyone good? Okay. Next step, what do we do first? Tax the ordinary income, the $71,000 first. Tax ordinary first, okay? You go to your table, they're married, you look at your married filing joint, you calculate the regular tax, okay? That works out to be, you guys are not going to walk through this step. If you don't know how to do this, okay, please come see me. If you cannot calculate this by now, you have to come see me, okay? That's the tax on the ordinary income dollars. That's our first step. 978750. Okay. But we know we still have to go back and tax this $9,000, and we know it gets special treatment. Okay, so we're not using our regular 7 bracket system anymore. We're going to use our 3-tier system. Okay, this taxpayer, they're married, filing joint. We brought them up to $71,400 using ordinary dollars. So we filled almost all of this 15% tier, right? We're pretty close to the edge here. So to figure out exactly where we are, that tier 1, ends at $74,900 for married filing joint. Minus $71,400 we've taxed. That leaves us with $3,500 left in tier 1 available to us. Okay? What are we taxing that at? 0. So there's 0 tax on those $3,500. We still got, go ahead.
No.
You good?
We're working it out.
Okay. We still have some more dollars to tax though, right? We've taxed $3,500 of our $9,000. So we have to tax the other $5,500. Okay guys, we've taxed $71,400 plus $3,500 of capital gains. We have completely filled up tier 1. So we're forced into tier 2 to collect on our next $5,500, right? Does everyone understand that? Okay, so it's gonna be at 15%. Which is $825. Okay, so our total tax are these three things. The tax on the ordinary dollars, this 0 on the first 3,500, plus the 825 on those last $5,500. So our total tax, you got it. Guys, are you with me on this? Mm-hmm.
But like part 0, like five, yeah,
This part, the 825?
no, so like the 500, the 500.
Yeah.
Yeah, we go over
Yes.
that 500.
Right, here we tax our ordinary dollars, 71,400, okay? That was our first step. But we still have to go back, right? In total, we have to tax 80,400. So far, we've only taxed 71,400. So we have to go back and tax this extra $9,000 of long-term capital gains, okay? This is where we're doing it now. We've used up 71,400 of the first tier. Okay, there's still a few dollars left in there for us though, because that tier ends at 74.9. So take your 74.9, the very end of that tier, minus the dollars we've used, the ordinary dollars we've taxed. So that means there's $3,500 left that we can apply towards that $9,000 in tier 1 at 0%. You got your comment?
Yeah.
Okay.
You just do 35,000, take away the 9,000.
No problem. Well, that's what this is. I mean, this is the $9,000 minus the $3,500 we taxed. That's the $5,500. That's all it says.
All right.
Yeah, that's it. All right, we good, guys? All right, let's do the second part just to make sure this is something good. Okay, so same taxpayers, same salaries. They change their gains a little bit. Okay, guys, what do we do? Net shorts, net loss, right? Net shorts, net loss. So our short term is 1,500. Our long term is 3,000. Okay? So we have two pluses. So we don't want to net it anymore because we need to keep the character of these losses. So when I fill out my tax formula, I'm just going to redo this a little bit. Okay? This time I'm going to report $4,500 of capital gains. Okay? And because there's long-term capital gains in there, some of it is in fact preferred. $3,000 is preferred, so mark it somehow. If it was all short-term gains, guys, we don't care. Okay, you wouldn't have to mark it, and when you came here, you would just tax it all away at ordinary rates. But because there's long-term gains in this number, when you get here, you have to stop.
How come on this one you said you don't net them together, but on this one you netted the 16,000?
Well, when you report it on the tax return, you do, you put one line. Like, there's only one line on the tax
just
return
for
for
the
capital
capital.
gains. So this is actually the way it would show on the 1040. But you're not netting them, meaning you're not diluting the character. They each maintain their short-term and long-term character.
Right, but we still put it as the, up there.
You put it as one number on the form, yes. Okay, so you would put it as one number again here. This is gonna change to 89,500, as is this. Our deductions are gonna be the same. Except for now, we're gonna end up with 68,900 of taxable income. 3,000 of which is gonna be preferred, right? The other 65,900 is gonna be ordinary, okay? We're gonna tax that first. If you do your taxing on your ordinary of $65,900. Okay, using your regular tables, it's $89,6250. It's your ordinary tax dollars. Okay. Now again, we know Samara trying to join $65,900. We're somewhere in this 15% range. Okay, so we're still in tier 1.
Quick question.
Yeah.
What do you do with the 1,500?
Well, the $1,500 and the $3,000, they're both income. Okay, they're both forms of gross income. So you have to report them on your return. So this $4,500 goes on your return and becomes part of your overall gross income number.
Yeah, I'm talking about a total income. I see you separated 3,000 for preferred
Yeah.
taxes, but what about the 1,500?
Well, that's just because it's part of your ordinary dollars, right? Short-term gains don't get beneficial treatment, which is why I'm not calling it out down here for beneficial treatment. They're getting lumped into this number. They become part of that. You just pull out whatever's preferred, and anything that's not preferred becomes ordinary by default. Okay? So here, we taxed our ordinary of $65,900, got that number. Now we're trying to figure out how many dollars are left available within tier 1 for us to use. The tier ends at $74,900, that's where the red line is, minus the $65,900 that we've taxed. Okay? That's leaving us $9,000 available in that tier. We only need to tax $3,000, right? So all of it is going to be at 0%. Okay? So our total tax is going to be $89,6250. Right? Because after we tax $65,900, there's still $9,000 in here. There's still $9,000 worth of space. We only have to tax $3,000 more of long-term gains, so that $3,000 fits in here. It doesn't push us into tier 2.
So it's like a $10,000 calculation.
Then $1,000, exactly right, will push us over into tier 2. Right. Guys, you good? Make sure you got this because it's going to get more difficult when we go to 28 and 25.
So then again, so you still have $9,000 at this point that you could possibly tax, and you only need to tax $3,000 of it?
Right, because the ordinary income was $65,900. This tier ends at $74,900. So $74,900 minus that $65,900 means there's still $9,000 that I haven't used up for taxing purposes. We only have $3,000 of preferred gains that still need to be taxed. So that $3,000 fits in here. There's no need for us to push in. If anything, there's still $6,000. We could have taxed $6,000 more of capital gains at 0%. Okay? We good, guys? Okay. Okay. Ready for 25 and 28? Fun stuff. Okay. Process is going to change a little bit now, guys, because here's the idea. The 25s and the 28s, guys, these are still preferred gains, but they get treated differently than our 0, 15, or 20s. Okay? So they're still preferred. We're still going to pull them out when we get down here, but when we get down here, now we kind of have to break this out into 3 components, okay? Because each of them is going to get taxed differently, and there's a very specific order that you have to do this in. So, okay? Again, you may be given a bunch of transactions. You start off in the same exact spot. Net your shorts, net your longs. That's always where you're going to start. Guys, if it tells you in a problem that there's short-term carry forward or long-term carry forward from the year prior, you have to pull that into your transactions for the current year and net it with your shorts or your longs accordingly, okay? So if they tell you there's carry forward from a prior year, pull it into your current year transactions. Don't miss that, okay? You're allowed to use them with your current year, okay?
You said this short-term carry forward will pull into the current.
Shorts.
So would that not be considered long-term when we're netting it?
Wait, say that again?
If it was short term from the previous year, that would mean this year now it's owned greater than 1 year, so when you're being.
It doesn't, it keeps its character. No, so the short term, that's why when they tell you you have to use your shorts first, your longs second, but when it comes forward into the next year, it keeps that short and long-term character. So that's why you have to put, if you have short-term carry forward, it goes in with your netting of your short terms.
Why doesn't it change so long?
Because you only held the asset for that amount of time when you got rid of it. They don't even have to technically let you carry forward, right? I mean, they're almost being generous by letting you carry forward at all. But when you sold that asset, it wasn't a preferred asset because you didn't keep it for a long enough qualifying period of time. So it's always going to keep its short character. They're only going to give you the preferential treatment if you hold an asset for more than a year. And that doesn't change just because you're carrying it forward.
So you have a carry forward like long term like 10,000 and your gains for that year more than 10,000. Can you use that all
You
10?
can keep carrying it forward.
Or
No,
only at 3?
you could only ever use your gains or your losses to offset any capital gains and then $3,000. I'll tell you, like, my husband sold a partnership in New York a bunch of years ago, and we didn't have a whole lot of capital gains. I mean, we've literally been taking like $3,000 a year, $3,000 the next year. Maybe we got lucky one year and sold something and had some capital gains, but then it would be like you basically could take $3,000 a year for the next 20 years. So no, you can only use them to offset any capital gains, and then $3,000, and then anything that's still left, you move forward into the next year. Yeah. Yep.
So you can offset both short-term and long-term capital gains?
Yes.
Okay.
Yes. They just make sure you put them in the right bucket, shorts or longs. Okay, guys. I think what we'll do, rather than reading through this, let's just skip to the example, because I think that's usually more helpful than trying to talk through the sheets. Okay. Let's go to example 5 on the page. Okay. Once again, you have a taxpayer. Okay, and he's got a whole bunch of transactions here. Okay. You have to stop. You have to look at them. How long did he hold them? 1 year exactly or less. Market is short term. Did he hold it longer than a year? It's long term. Is it a special type of property? Is it going to be a 28% gain, or is it going to be an unrecaptured 1250 using a special 25% rate? Okay, these are all the things you're looking for. Be on the lookout for losses. You see losses? Are they personal use losses? Do I have to scratch them off my list? Is it a non-capital asset? Do I have to scratch it off my list? Okay, this is what you're looking for. Don't start calculating until you've worked your way through this list. So we have this taxpayer here. He sold some stock. He has some rental property. Okay, guys, again, on an exam, I will tell you it's a 1250 unrecaptured gain. It's up to you guys to know that it's 25% rule applies, okay? He's got rare coins, okay? If I say something like he's got rare coins or stamps, you guys need to know the special 28% rule applies. There's some carry forward on here. Okay, scan your list. In this case, he doesn't have any personal use or non-capital assets, so we didn't have to take anything off of the list. First step, once again, net your shorts, net your longs, okay? If your longs are positive, there's another step involved, right? Because within that long-term number, we don't just have our standard 0, 15, 20% properties. We now have our 28% and maybe our 25% properties, and each requires special treatment after another netting process, okay? So if you net your shorts and you net your longs, and your longs have a positive result, and you know there was 25 or 28% properties involved, we have to go through this next sort of what I will call fanning out process, okay? So here, I'm referring to this list on the first page, guys. You set yourself up. If you guys have a better way of doing it, by all means, but just make sure you're gonna end up with the right result. This is the way I do it. Start with the short terms, then work your way backwards. 28% properties, 25% properties, and then our 0, 15, and 20 properties, okay? Take your transactions from your list and put them on here. So the first one says he has a long-term capital loss of 54, okay? He's got a short-term capital loss of 8. He's got rental property, I wrote 25%, okay? So that obviously goes here, under there. We've got another long-term capital gain of 50. We've got a 28% gain of 25. You've got another short-term loss of 3. Okay, this is carry forward. This one was carry forward, but I put it in with my shorts. Okay? Now the rule when it comes to long-term carry forwards, after you get past the netting process, okay, when you're mapping it out on here, says if there is a gain in the 28%, you put it there. Okay, you start it there. If there's not enough dollars here, you keep moving down. Is there dollars here to offset it with? I have a gain here enough to offset that $15,000 long-term carry forward, so I'm going to put it under here. Okay? So when it comes to that long-term carry forward, you start by trying to put it here if there's enough dollars to absorb it. If there's not, you can move some of it here. If there's still not enough dollars here, you can move some of it there. Okay? Long-term carry forward. Start here, work your way down. The idea is to offset it.
Can you say the rule one more time?
Yes, long-term carry forward. So this is something you're pulling forward from last year. The rule says you apply it first to the extent there's 28% gains available. There is in this case, okay? So I could stop right here. If I had no 28% gains or not enough, then I will take it and start to move it here. Maybe all of it, maybe just some of it, okay? Use it to offset 28 gains first, then use it to offset the 25s, then use it to offset our last category, our 0, 15s, or 20s. Okay?
So that was like 35, you would do.
Well, here it's fine, right? Because it's a 15 loss versus 25, so this loss will get absorbed into that gain, no problem. If this was 10 instead of 25, I would use 10 here and make this 0 net, and then I would take your other 5 loss and put it here. Okay? The idea is you want to use up the 28 first, then 25, then 0, 15, 20. Okay? I know this is tedious, guys, but this is what the rules
So this
are.
is long-term capital gains?
Just the long-term capital carry forward I'm talking about right now.
Oh, this is loss.
The carry forward loss.
Okay.
Yep. Loss is the only thing you'll ever carry forward. You don't ever carry forward gain. Okay? And this is the short term just gets put here. Long term, you have to look and see if there's gains. Okay? And there are here. So that's where I'm going to put it. Okay. Now just sort of add them up and see where you're at. Okay? 10, 50, and I got 4. Okay?
How come you're allowed to do more than 3,000 though for the losses? Because I thought you said you only can offset 3,000 each year.
No. Losses offset any capital gains, then you're allowed to take $3,000. So there's gains available this year. So we're going to use up those losses to the extent of gains first. Then I'm entitled to $3,000 more if I ended up with a net loss.
So you're applying, long-term compared to short-term gains. That $15,000 is a long-term gain.
Yes, but 28% is a long-term gain. So long-term is offsetting long-term. This was a long-term carryover, this 15, and it's offsetting a 28% gain. 28 and 25, they're all technically long-term gains. Okay, so it is offsetting long-term. Okay? So once you kind of plotted everything where it goes, net it out, see where you are. The next rule says if there is a loss in this last category, you're 0, 15, or 20, you do the same thing. You try to offset it against 28 first, then 25. So here, there's still money in the 28% category. So we're going to offset it, okay? So we got rid of this. We still have this. We have 6 left here, and we have 11 there. Okay? I'm getting rid of this. The rule says if there's a loss, this is the next thing you look for. If there's a loss in this last category of 0, 15, or 20, the rule says that you take this loss and you first try to apply it against any 28% gains. If there's not any available or not enough, then you move to the 25% category. There was enough available here, so I'm going to offset them there.
So
if
you
there's-
start off with the 28%?
You pretty much always start 28. This is the code's way, Commerce's way of being kind. They're letting you do away with these potentially higher tax items first, right? We're trying to get rid of the 28% first, then the 25. So hopefully we'll only end up with these 0, 15, or 20s because these will be taxed at these rates. So it's almost their way of being kind if you can figure out the formula.
So if there's extra leftover, so say it's like 51,000 after the 25%, the 1,000 would be carried over to next year's as long-term capital.
Well, we're gonna end up with a gain here, so there's nothing getting carried over here.
Right, but I'm saying if there was, like, say the 50,000 was canceled out, and then there was like 1,000 left over, the 1,000 would be used
If we
next
ended
year.
up with a loss, yes, like somewhere in one of these three categories, okay, you would use 3,000 this year, starting from the short term.
3,000 again from the short term? Because you took out 3,000.
I didn't take anything. No, I'm adding these. This was from last year. This was a current year short-term loss. This was carry forward from last year. So in total, I have 11,000 short-term losses now in this year.
So
okay?
the first 3,000 was categorized as short-term loss.
Because it was carry forward, I pulled it in from last year.
Carry forward, and then it'd be an additional 3,000, and then anything on top of that would be carried forward until next year's long-term.
If this, let's just leave that alone, okay? Let's just assume this worked out to be negative $10,000 between these three categories. Then that means for this year, I would have $21,000 of losses, 11 short and 10 long. So I've already offset any capital gains in the process of doing this. So then the rule says after you've cleaned out your capital gains with losses, you're allowed then to report on your return $3,000 of loss, and then what's ever left over, you carry forward.
And that's long-term, goes back to the 28.
Now, you take the 3 from the short first.
Right, but I'm saying after you do that, what you have left over, it goes back into the process of the beginning of next year, the 28.
You would start all over. So I would carry forward next year 8 of short-term loss and 10 of long-term loss. And that's how they would carry forward next year. So yeah, next year I would drop $8,000 in here and I would drop $10,000 in there. You follow it?
Yeah.
Okay. All right, guys. So we still have some netting to do now. Okay, so the rules say first, look out for that long-term carry forward. Put it in the 28% category first, work your way down if there's no dollars available. Then look for a loss in this end category, the 0, 15, 20. Same thing, start at 28, go to 25, try and get rid of the loss, okay? If there's still dollars here, now, third, you come to the short-term category. If there's a loss here, we do the same thing. We're gonna clean it out, okay? There's only $6,000 available here. I'm gonna use it all up. I'm gonna take the other $5,000 from here, okay? So I got rid of this, I got rid of this, I got 45 there, and I'm done, nothing there, okay? So this means when I went through my formula here and added that $45,000 of capital gains, I would add $45,000 in here, okay? When I come down here, I would pull out $45,000, anything else is ordinary, and I would tax it using rules that we'll get to, okay? We still haven't done the taxing. This is just the netting.
We'll do it the same way you've been doing this.
The rules change a little bit now. The rules change. The 25s and the 28s have different rules. They don't follow the same process. Let's see if we can get, we'll start at least 6 and see what we can get in. Because this will walk us through some of the taxing. So we have a taxpayer, all right, she's single. She's gone through her netting process and has the following gains to tax. So she has, we already did our shorts and our longs. She's got net short-term gain of 5. She's got net long-term gain, $26,000 of which is 0, 15, or 20 gains, and $5,000 of which is 28% gains. And I tell you, she's also got $3,000 of other taxable income. Okay. So this taxpayer, again, we're starting now at taxable income. We've taken our deductions out. She's got $39,000 of taxable income, okay? The rules say when you get here, pull out your preferred gains first. I've got $31,000 of preferred gains, right? I'm pulling them out, okay? The other $8,000 are ordinary income. You go, you tax your ordinary income first. Use your regular system. Okay, that gets us $800. Okay. The rules say, this is the order you now have to work in. If there's 25% gains, you tax those first. If there's 28% gains, you You tax those next, and then our 0, 15, 20s get taxed last, okay? 25, 28, 0, 15, 20. That's the order you have to work in if you had all three, okay? We don't have 25s here, so we're gonna start with our 28s, okay? Of this number, okay? We had 5,000, which is 28, and we had 26,000, which is 0, 15, or 20. Yes,
25s get taxed first or 28s?
25. Changes the rule, right? Because you just got used to this, where I said 28, 25. When it comes to taxing, it's 25, 28. Right? Yes, it's great. They like to help you out. Yes, it's backwards. Okay. So we tax that first. Now we're going to work on our 28s. Okay. The rules with 28s and 25, guys, says if you're taxing those dollars while you're in the 10 or 15% brackets, you use the 10 or 15% rates. Okay? So assuming you only have, a little bit of ordinary income dollars and you're still in the 10% bracket, you start to fill out first using 10%, then as you need to, 15%. Once you fall outside 10 or 15%, they get the 25% or the 28% respectively, depending on which type of gain it is, okay? So you don't use, for the 25s and the 28s, this three-tiered system, okay?
So, in real life, how would you know that your taxes were being at 28%?
How would you know?
Yes.
Well, you would have to know what kind of asset you sold, right? This is where I said you'd have to know how long you held it. Did I hold it for a year? Because that's important. And you would have to know. You have to have that documentation to say this was a collectible. It meets the terms. We're not going to study the specific terms.
I just wanted to know.
You would have to have documentation, okay? Okay, but the rules say, so right, first we tax our ordinary income, 7-tier system, we've got that. Now we tax 25, then 28. If you're taxing 25 or 28 within the 10 or within the 15, you use those rates. If you're taxing them outside of one of these first two brackets, they get their respective 25 or 28% rates, okay? So here, we taxed $8,000 worth of ordinary income. Well, this goes up to $18,450. So we still have $10,450 within that 10% bracket that we can use.
Didn't she say that?
Yes, I'm using the wrong chart, thank you. Yes. 5,000. So we're trying to tax $5,000 with 28% gains, thank you. We used 8,000 of this 9225. So there's still $1,225 within the 10% bracket, right? So we're going to use that first. Right? Now we're taxing our 28%. And it's for $5,000. So the first 12,225, okay, because there's still room in that first bracket, you're going to get taxed at 10%. Okay? We still have to tax the other 3775. 3775. But that put us over, okay, now into the 15% bracket. So we taxed $8,000 ordinary income. We taxed $1,225 towards that $5,000. So we still have $3775. That pushes us into the 15% bracket. So the next $3775 is going to get taxed at 15%, which is 566.25. Okay? So we've taxed now the 28% item. We still have to go back and tax our $26,000 of regular long-term capital gains. Okay? So the idea now is we've taxed $8,000 of ordinary income, $5,000 of 28% gain. We've taxed $13,000 worth of income. That's where we pick up. Okay? So we taxed $13,000. So we're somewhere in here. Okay? Because we're going to our regular long-term capital gains, we're switching over to our three-tier system now. Okay? Our tier ends at $37,450. Now it's the regular, we're going back to the rules we just learned. $37,450 minus the $13,000 we taxed up above. is, where is it? 24,450. Okay? That's how much room is still available in tier 1. Okay? We've got a tax of $26,000. So not all of it's going to fit in here. We're going to use up what we can, the 24,450 at 0%, because this is still in tier 1. So it's going to get 0. Okay? We've got a tax 26 though, so the other 1,550. Now we're in tier 2, right? We've pushed over into tier 2. This is going to be at 15%. This is 232.50. Okay? So our tax is the $800 on the ordinary income. These two guys from the 28%. Okay? And these two from the long-term capital gain. So in total it's 17, 21, 25. Okay? The 28 and the 25 guys, again, if you're taxing them in one of these first two brackets, use those rates. If you're forced outside of those first two brackets, they're either going to get the 28% if it's a collectible, or they're going to use the 25% rate if it's the unrecaptured 1250 gain. Okay? Then you tax the long terms last. You go back to your tiering system, 0, 15, or 20. We'll do more examples on Thursday.